If we are entirely honest with ourselves, then nobody really has a clue where crypto prices will be going from here. They might go up, they might go down, they might come in circles. We all just make random guesses. Some of them are random, some of them are a bit more educated. We're trying to figure out structure, as in patterns in the data, to predict what might come. Now, some of those patterns might break. No mathematical, no statistical model is perfect, but I do believe that a lot of them are useful. Here's, for example, a pattern that did not hold up. You might not have been around at the time, but there was the theory at one point that Bitcoin's price would never fall below the 200-week moving average, or the 4-year moving average. It always bounced off that level. And the fundamental thinking behind this idea was that Bitcoin should be moving in 4-year cycles, because every 4 years, the newly issued supply of Bitcoin gets cut in half. The token issuance of Bitcoin goes down every 4 years. It's currently at 0.85% per annum, and 1 year ago it was at 1.7% per annum. In April of 2028, we will drop to 0.4% per annum. And so this predictability of the tokenomics in Bitcoin's newly issued supply is what led to the theory that Bitcoin's price, because it becomes more and more rare over time, should never fall below the 4-year moving average. But have a look at what happened. We in the end did fall below, by not so little actually. The moving average was at $24,000 and we fell all the way down to $16,000. A drop of 32% below what people expected to be the absolute bottom in the Bitcoin price. And so that's then the big question, right? When you're facing this kind of a chart, are you going to buy that bottom? It seems like the model has completely broke down, but of course 16K was a very good time to buy Bitcoin. We all know what happened afterwards. Bitcoin went up to above 100K. And so what do I mean that models break but still might be useful? In the future, we could still fall below that moving average. But if we do, we are probably comparatively low, as in it doesn't make sense to buy more than usual. And currently, the 200-week moving average is at $52,000. That's the kind of volatility we've seen in the past. Now, I'm not saying that it makes sense to wait all the way until we fall below in order to buy Bitcoin again. Because if you waited, say, in the last quarter of 2016, because the price was quite a bit above, you would have missed out on a massive rally where we went all the way to 20K. And only after a massive correction did we get close to the moving average again, which still was much, much higher than the price in the last quarter of 2016. So it does not make sense to wait all the way until we reach, but it does make sense to keep an eye on it, because in case we do get close to that price level, buying more than usual seems to make a lot of sense. There seems to be a reoccurring pattern in crypto. Because crypto tends to be very volatile, we tend to see bull markets heating up over time. As in, the gains tend to accelerate. They accelerate so much because new people enter the space. People that have never heard of crypto before, or that maybe aren't really that close to investing, to the whole idea of investing, they might suddenly feel pressured to buy into Bitcoin or into crypto in general, because they don't want to miss out, right? The fear of missing out, the FOMO. Now, because bull markets tend to accelerate, we can potentially find a top signal, as in when the price has moved very quickly, maybe it makes sense to sell at that point. There is an indicator that quantifies the acceleration of a bull market and tries to pick that top. And that indicator is called the Pi cycle top indicator. Now, why is it called the Pi cycle top indicator? The naming comes from the ratio of two moving averages. So we're looking at the 350-day moving average relative to the 111-day moving average. There's nothing really scientific about those moving averages. The only thing that's so impressive about this indicator is that it was built based on this data set over here. So the cycle top here, the cycle top here, and the cycle top here, as in the shorter term moving average crosses the longer term moving average, which means the gains are accelerating, which means this purple area here is at 0. And exactly at those points in time, right, the red dots is when we saw to the day the cycle top. So this is when the bull market was extremely heated and when it made sense to sell. Now, what's fascinating about this indicator is that those three tops were known when the indicator was developed. However, the next data point was not. And so let's zoom out. This cycle top over here it was predicted by the indicator. It was not fitted through the data. This was already when the parameters had been set from the prior data. And so this, I believe, is a very nice example of how structure and patterns in the market can prevail and how it does make sense to dive into the data a bit more. I do not think that this is coincidence that the fourth data point fit that closely to the crossing of the moving averages. It also makes sense. It's simply just an accelerating bull market. And as we are extremely hot, it makes sense to sell exactly at that point in time. If your grandmother or your taxi driver suddenly asks you about Bitcoin, it's probably time to get out. And I find it fascinating how well this actually worked. This is where the moving averages crossed, and just one day afterwards, we saw the cycle top. Now, nobody knows whether or not this indicator will continue to work. It seems like currently the bull market is rather slow, as in it's very hard for the short-term moving average to cross the longer-term moving average. Or there is still quite a bit of a delta. We are not yet at zero in this purple indicator, but it definitely makes sense to keep watching the Pi cycle top indicator. Simply search for this in Google. There are several websites that track this in real time. And I'm not saying that this will continue to be the perfect indicator in the future, but I do think it's another useful data point. Very similar to what we had with the 200-week moving average. It doesn't have to be the case that we will exactly bottom out again in the future with the 200-week moving average. It could simply just show us a potential region where the market might be very cheap. So that's for the moving average, or a potential region where the market might be expensive. And that's for the Pi cycle top indicator. It doesn't have to fit perfectly as it coincidentally did in 2021. Now, what I like about the Pi cycle top indicator is that it uses psychology. As in, we're not trying to find the fair value of Bitcoin. We're not comparing Bitcoin's market cap with the market cap of gold. We're just looking at how quickly did Bitcoin appreciate in the past. And if that appreciation was too quick and the market might be heated, people might take profit, and that's the time to sell. That's what I like about the indicator. What I do not like about the indicator, that it leaves out a lot of data that can also make a judgment call about the reference price of the market. Because the Pi cycle top indicator just looks at price data. But that's a nice thing about the blockchain. We've got much more data than just price data. And thus we can have a more refined picture of what's actually going on. This is a chart we cannot find for traditional finance. This is only a chart we can calculate with blockchain data. It shows us the net unrealized profit and loss because we've got information about every single Bitcoin. When did it move the last time? And we compare the price when it moved to the current price. We know how much are people currently in unrealized profit or in loss. And when people are currently a lot in profit, it might make sense to realize some of that profit. At least many people think so. And that's when we tend to turn around. When a lot of people are in losses, then there's despair. People rather want to not be involved. And that's, of course, the best time to buy. So we want to be contrarian. There is something fascinating with that chart. It seems like the tops tend to align quite well. As in, people tend to take profit earlier and earlier. They tend to rebalance more and more because now the market cap of Bitcoin, of crypto as a whole, is much larger. And so it takes more money to push prices up or down. So the volatility tends to decline. But the same is true on the downside, as in people aren't that much in net unrealized losses anymore. People tend to buy the bottoms more. Bitcoin as a whole is maturing. The price volatility tends to go down. Now, this chart doesn't tell us the best story. It tells us that the market might be quite expensive and that there is some downside. We are rather on the higher end of this range. But there's one thing I want to point out. In the recent past, the net unrealized profit went down from top to top, but the price itself went up. So one could argue that the market now is less heated today than it was 1.5 years ago. The price still went up. So the price appreciated comparatively slow. The market did not accelerate quicker than it can digest. Or it's not like the prices are going up because a lot of short-term speculative money is in the market. It's rather the opposite, right? Now it's the treasury companies, now it's the ETFs that just tend to accumulate long-term. But they accumulate relatively slowly. They don't accumulate that quickly that the price is going parabolic and might suddenly crash down afterwards. And so just because we are very high on this range doesn't mean that the price has to crash down. We could simply just stay at the upper bound while the price continues to appreciate. We can dive even deeper into the data. We can have a look at the net unrealized profit and loss based on who's currently in profit and loss, the long-term holders or the short-term holders. So yes, it becomes a bit more complex, but it's also interesting to have a look at this. The long-term holders, they are shown by the blue line over here. So sometimes the long-term holders are in losses, and that's a potential time to buy. And sometimes they are massively in gains. It's a potential time to sell. Here, on the other hand, are the short-term holders. This oscillates much more frequently, and of course, if the time horizon is short, it might make sense to buy those dips. But the dip can keep dipping, as we have seen during the 2018 crash. Combining both gives us an idea of who's actually driving the cycles. It's profit taking by the long-term holders. The long-term holders are moving much more capital than the short-term holders do. And so everything is always about the reference price. It's always about how much are we currently in profit or in losses relative to at what price we bought it. It also works for the individual investor, right? Let's say we buy Bitcoin today and now Bitcoin goes down. What are we likely going to do? If we believe in Bitcoin very long term, if we believe that Bitcoin will outperform fiat because the supply is shrinking and the fiat supply is expanding all the time, over the very long term we expect Bitcoin to appreciate. If we are currently in losses after our purchase, we tend to just keep holding. We tend to not necessarily sell if we don't have to, if our time horizon is long enough. But now consider the opposite. Let's say we're buying Bitcoin and suddenly Bitcoin doubles and triples and quadruples. At that point, we might consider to realize some of the profit, because at the beginning, maybe only 20% of our net worth is in Bitcoin. Now, after it goes 3, 4x, maybe 60, 70, 80% of our net worth is in Bitcoin. We don't want to have that much exposure to Bitcoin, especially after a rally like this, and especially if we know that Bitcoin can crash 50, 60, 70%. So we want to realize some gains. So the current price relative to our purchase price does matter. And it matters for the individual investor. It also matters for the overall market. And the reference price for the overall market is called the realized price. So this just looks at what price on average did Bitcoin move if you look at all market participants. Now, isn't that fascinating? It tells us again exactly that story. The selling pressure tends to go down. That tends to be a bottom once we are below the average cost basis of the market. Once people are in the red, they simply just keep on holding their Bitcoin. And then there are a few dollar cost averagers that just continue stacking sats that then create the bottom and are the basis for the next bull market. And we can then try, just based on this cost basis, at what price Bitcoin might be topping out. So we're just adding some buffer at the bottom and at the top. And it seems like at 1 to 2 standard deviations from the realized price, we might be, at least temporarily, quite heated. Currently, that upper bound is at 147K, potentially in the very best scenario at 190K. And so there's the average cost basis of the entire market. There's also the average cost basis of only the long-term holders. This tends to react a bit slower, as in the long-term holders just keep on riding the rally, and then they realize the gains once we top out, which causes parts of the bear market. The market as a whole tends to sell much faster, as in there are the short-term holders that realize profit every now and then. But what's interesting is that at the end of a bear market, we tend to also have long-term holders being in losses. So currently, that long-term holder average cost basis is only at 36K. Now, I'm not saying that we go all the way down to 36K again. All I'm saying is that it makes sense to watch this price level and to watch very closely when the long-term holders are taking more profit, because this is when the market tends to become less stable. People think that a lot of those models should be breaking down in the future, because now we've got the ETFs, now we've got the treasury companies. They tend to just accumulate Bitcoin. They tend to just buy up more of the supply. And so maybe we don't really see those kinds of bear markets anymore that we saw in the past, these drops of say 70 or 60%. But I tend to disagree, because yes, it's true. The ETFs tend to buy most of the time, and that purchase is higher than how much Bitcoin gets issued all the time. So yes, the supply does dry up over time, but still the movements that we have through the ETFs are very small compared to what the long-term holders are actually moving. The long-term holders determine when they are selling that the current rally is over and they determine that the current bottom is in whenever they're buying. So they tend to sell at the top and they tend to buy at the bottom. I don't think that the ETFs and the treasury companies change that dynamic. The treasury companies move even less Bitcoin than the ETFs do. And so it still makes sense to look at what's happening on chain. How much is the market currently in profit or in loss? And the market value to realized value Z-score looks at this relative to the volatility of Bitcoin. So it tends to top out at similar levels. It tends to bottom out at similar levels. And all this indicator is doing is it looks at the current price relative to the average cost basis and takes this delta and divides it by the current volatility. As in, if the price is more volatile, we accept a higher deviation. If the price is less volatile, we accept less of a deviation. And this gives us a somewhat constant range to tell us when we are expensive or when we are cheap. And again, this indicator as well tells us that currently the market tends to rather cool off. The MVRV Z-score tends to go lower while the price continues to go higher. So this is a healthy rally. The rally is not accelerating more and more to bring us to a potential blow off top bear market. It's not the same as what we saw in 2017. We've got the same measure for the long-term holder market value to realized value Z-score. And here's the binary spending indicator of the long-term holders. Again, the long-term holders sell into the rally and they buy into the bear market. Currently, they're still selling, but not as aggressively as they did in 2017. It seems like everything is still quite healthy. It's always this battle between the long-term holders and the short-term holders. And when there's a lot of short-term holders in the market tends to be heated. We have a lot of transactions, short-term transactions. We don't have that many long-term transactions. And that's what the realized hodl ratio measures. So how many transactions are there among the short-term holders versus the long-term holders? It takes that ratio. And when this is very high, the market is heated. When this is very low, the market is less heated. What I find interesting is that over time, the short-term holder excitements tends to go down. So the short-term speculative money gets less and less excited about Bitcoin. But the bottoms tend to also align. So let's just draw this. It again gives us a picture of how the market is maturing. Very similar to what we've already seen with the net unrealized profit and loss. We see the same in the trading activity. And again, we are not super low, we are not super high, and we are rather cooling off during this bull market. So again, while there is some risk for downside, money continues to flow into the market at a sustainable rate. Not too quickly. Now, if you've watched a few videos on this channel already, you might see that I approach crypto quite differently to most others. Most others just try to find the next meme coin that does the 10 or the 100x return, but more often than not, those kind of bets just go to zero. I do the exact opposite. I bet on falling prices of the crappy altcoins. And I started trading for this community on the 10th of July. And so far, things are developing very, very nicely. The annualized performance is 79%, while the maximum drawdown was only 2.3%. So this is the exact opposite of buying a meme coin, where you're losing most of the time and you're hoping for this one lucky moonshot. When I look at other people here on YouTube, I don't really see them being that open, as that they show directly what performance they are doing versus the market in real time. And I also don't see them just trading for the community. Because it's not that easy to walk the walk, right? Most people just talk the talk. It's easy. Words are cheap, but performance is actually what matters. What I like most about this performance is that we started trading over here and Bitcoin went up and down and up and down. We already had our 12% corrections, and at the same time, the capital pool simply constantly appreciated, with again very little volatility. And so this is how most people get burnt in crypto, right? They see a meme coin, for example, how it's going up, and they're wondering how much higher can it go. So for example, this here, Bonk, right? Bonk shoots up. People consider, hey, should I maybe buy? They might be buying over here, and then things turn out positive short term, but then the exit is never found. Then the asset just continues to get held over time. And then prices crash further and further. And then as we settle at a lower price, that's when most people sell. Another rally follows. The hope is that Bonk reaches similar heights to the prior heights. And again, it doesn't work out. The issue really is that those exit points are much harder to find than the entry points. Prices tend to be low for a longer time than they tend to be high. Those exits are just very brief moments in time. It's the same with everything, right? It's also with Altcoin, as in the exit is the hard thing. The entry is okay. Buying when nobody is looking is somewhat possible. But selling when we peak in the price just for a few days, that's really what gets wrecked most people. Most people don't exit on time and then just see the price coming back down. The effect is of course the strongest with the meme coins. Right here we've got Dogecoin, the same thing. Things go up quickly. There's a few days where it might make sense to sell, and then if those days are missed, the opportunity of selling is gone again. I try to approach the market very differently. I try to look at what are most altcoins actually doing long term, especially the altcoins that have very high token inflation, where more and more tokens hit the market because the insiders want to sell, because the venture capitalists, they get now token unlocks. They are selling constantly and they depress certain altcoins long term. And I'm simply just betting on those altcoins continuing to do worse compared to the rest of the market. And that's how I make this long-term outperformance, and especially outperformance that's independent of the general market environment. This is one of my favorite websites. It's Tokenomics.ai. It lists various altcoins with their token unlock. And let's have a look, for example, at Fetch.ai. It went crashing and burning, and it's close to an all-time low relative to Ethereum. And the reason is, of course, token unlocks, as in there's more and more tokens that hit the market. And that depresses the price if the demand doesn't grow as quickly. And that's usually the case. Have a look at this jump over here, right, in July of 2024. This is really where Ethereum outperformed Fetch AI massively. Ethereum doesn't have all those unlocks. Ethereum's supply increase is very, very modest, but it's not modest for most altcoins. And that's where we see the outperformance of Ethereum relative to Fetch AI. This here is an outperformance of 177%. Have a look at this. I like to trash on this altcoin all the time here publicly on YouTube. This is Balancer. This is the supply of Balancer tokens over time. The Balancer DeFi protocol started with 20 million worth of tokens, and now the liquidity mining expands that supply further and further. And now we are at roughly 70 million BAL tokens. And here's Ethereum relative to Balancer. So it's just outperforming all the time. Or in other words, Balancer is doing worse. And this is how we make the performance. Balancer has no usage at all. The total value locked in Ethereum is going down. The number of tokens is going up. And so, of course, we see constant underperformance. And that's what we can make become our profit. So this again, Ethereum relative to Balancer. This blue line over here, that's the Ethereum price itself. So that's how much of a difference this makes, right? Ethereum crashes and rallies and crashes again and rallies again, or you just get constant outperformance with those relative valuation bets. I have a look at this at the bottom. This is the Bitcoin price during the same time. Again, Bitcoin can crash by more than 70%. And our position here just continues rising. The alpha in crypto is to simply do the same thing that the insiders are doing. The insiders are dumping on retail by having more and more token allocation. And we simply just have to make similar kinds of moves. When they are depressing the price and they make money with their price depression, we simply do the same. We are not insiders as in we don't really know what's going on with the project, but we do know that the project will have more and more tokens over time. And those tokens will be selling pressure. Now, unfortunately, the capital pool has already closed for deposits until end of the year. There will be a new capital pool starting in 2026, but for now we are just trading with the capital that's currently available that has already been deposited. But there's still a way to make the same kind of performance, because I still share every single trade that I make for the community pool. I still share that in a dedicated channel. And I want to share the two recent trades. For example, here I closed the Filecoin short after an underperformance of 8% in just 9 days. So we short over here, the price is going down. And then over here, we've got another one. Trump relative to Solana, it underperformed by 23% within 3 weeks. I'm closing those shorts after they get close to the lower end of the trading range. And then I look for the next entry opportunity once we are higher again. The background of those shorts is, of course, again, token inflation. Just have a look at Tokenomics.ai, see what Filecoin and Trump have listed as their tokenomics. But yeah, you can simply just copy trade whatever I'm trading. So here are a few wins of community members that post their gains here as well. Now, I understand the doubts. Just because I've been successful with this strategy doesn't necessarily mean that everybody that makes similar trades will also be successful. But I want to make this as simple as possible, and I also want to make this as risk-free as possible. So here's my offer for the first quick win. You simply join Premium and watch 2 videos that are 1 hour in total in length. You're watching this one over here, using perpetual futures on hyperliquid to bet on relative valuations. And you watch this one over here, very important, risk management with relative valuation bets. Once you've watched those two videos, you know exactly how to set up trades like this or trades like this, so that you don't continue losing money with roller coasters like this. Once you've watched those two videos, then please join the community chats. When you've joined the chats, I will get an alert message that you have joined Premium, and I will send you a direct message with my current favorite trade. A trade very similar to Balancer. Now, Balancer's token supply is getting close to its maximum cap, so it's not necessarily the best trade anymore. But it's a very similar trade that's still early in its infancy. It's likely going to perform very similar to this trade. Now, I will share my favorite trade with you, but also I will put a little guarantee to this. When you join this trade and you're not making money after 1 month of holding this position, then I will refund the membership fee to you 100%, no questions asked. So you can simply join Premium, join this trade. If you don't make money with it, again, you just get this money back. It's pretty much risk-free. You learn everything. You learn how to make all of those relative valuation trades. You can binge watch all the tutorials. You can just copy trade whatever I trade. If this initial trade that I'm sharing with you won't make money, you get that all for free. You're just risking the 125 US dollars, but if you're not successful, you get the money back. Now, the capital pool has already closed, but there will be a new pool at the beginning of next year. And if you want to be notified first before that second pool closes as well, then feel free to join the annual membership. You can start with monthly and then switch to annual later. You do not get access to the automated copy trading with the annual membership right now, but you will get a first invite as an annual member in January of 2026. A link to Premium will pop up directly on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in Premium. Cheers.